Welcome back to another edition of Intended Consequences, the official podcast of the StrategyCorp Institute of Public Policy and Economy. I'm your host, Sebastian Lebrec. Budget deficits and government debt is something public policy professionals and economists pay close attention to. At both the provincial and federal level, governments have been recording budget deficits for several years now, which raises the obvious question of how much debt is too much debt? Is there even such thing as too much debt? Opposition parties usually love to use deficits as a line of attack against governments. While politicians might look at deficit and debt through a partisan and sometimes ideological lens, players in the financial sector look at these things through a different angle. For instance, you've probably heard of credit rating agencies, which can rate governments and public sector organizations like hospitals and utility companies. Every time an agency issues a government rating, it usually makes the news in Canada, so it highlights just how important they are. To learn more about credit rating agencies and how they look at the current financial situation of governments in Canada, I'm joined by Travis Shaw from Morningstar DBRS. He's the Senior Vice President and Sector Lead for Global Sovereign Ratings. DBRS is one of the top 4 credit rating agencies in the world, so Travis brings a unique perspective. Thank you so much for joining me, Travis.
My pleasure, Sebastian. Happy to be here.
So what should our listeners know about Morningstar DBRS?
Yeah, I guess a little background on the organization itself. So Morningstar DBRS got its start in Canada back in the late 1970s, 1976 to be precise. So we're coming up on our 50th anniversary. So we've got a pretty long history of providing institutional and government credit ratings in Canada. For the last number of years, we've been part of a broader Morningstar organization. But the credit ratings business, even though it's global, we have offices both in US and different parts of Europe, is nonetheless still headquartered in Canada. So it has been, I would say, a Canadian success story. It's the only Canadian credit rating agency still operating, and we continue to see growth globally. So definitely happy to share our opinions and get our views out there.
So speaking of opinions and credit ratings, can you tell us at a high level what they are and why they matter?
Certainly. So the best way to think about it is just on an individual basis. So both you and I have a credit rating. When we go to the bank or go to a car dealership and want to take out a car loan or take out a mortgage at the bank or even sign up for a new credit card, those lenders, those financial institutions are going to look and check our credit history. For individuals, we have a numerical credit rating score. It's usually somewhere from 300 to 800, with a higher number indicating a better credit score and a greater likelihood that you're going to be able to pay those obligations when they come due. So in our world, we're looking at ratings more on an institutional and corporate basis. So we use a letter grade scale, and that starts at AAA, going to AA, single A, all the way down to single D, which would be an indication of default. This is what our peers use that started before us. The scales differ a little bit across our peers, but generally they follow the same format. And what that credit rating signals is it signals to investors that are buying those securities, buying those bonds, what the likelihood is that that entity is going to be able to repay those obligations, make interest payments, make principal payments when they come due. Again, like your individual credit rating, a higher credit rating is an indication of greater likelihood that you can service those obligations, less likelihood that you'll default. And often it can also play a role in determining the cost of borrowing for an entity. So a lower credit rating signals perhaps an increased likelihood that you may come under financial strain or you may eventually default on those obligations. And so the lenders that are lending to those organizations are going to require a higher interest rate or a higher coupon to take on that risk. And the same happens both for individuals and for large organizations.
So you mentioned that you're focused on the ability to repay debt So obviously you're kind of looking at the present, but also thinking about the future a little bit. And we know that it's a bit of a hard exercise right now because the economy is a bit in flux. Donald Trump is back in the White House. There are tariffs, a lot of uncertainty. So how does this uncertainty impact your work and how you rate governments and companies?
Yeah, that's a great question. I would say uncertainty itself doesn't strictly change our approach. We use what we call a rating methodology, and we have different methodologies for each sector. So we have one for sovereign countries, one for sub-sovereign governments like provinces and municipalities, one for airlines or construction companies. And we look at those, what we consider to be kind of key methodology factors in how we assess an entity. In the current environment, you're right in that certainly the level of uncertainty is higher than what we've seen in years past, but it's nevertheless something that we feel we can manage. It doesn't impact those key rating factors that we look at, but it does I guess play a role in our confidence in the future and the forecast that for instance our government clients would present to us. So and we see that in provincial budgets. For instance, they've all presented a range of possible scenarios in terms of their fiscal and debt outcomes, given the uncertain economic environment that we find ourselves in.
So let's talk about government. We'll start with the Government of Canada. DBRS confirmed the long-term AAA rating last February. So what are the areas of strengths and perhaps risks that DBRS identified in its review of Canada?
Yeah, I mean, if we look back in February when we last released an update on the Government of Canada, it was certainly a highly uncertain environment. We were just in the midst of a new U.S. administration, significant tariff threat at the time, and also political uncertainty domestically in Canada in terms of, we're in the midst of a leadership race for the Liberal Party and the expectation that a federal election would be forthcoming thereafter. So what I would say is, fast forward to today, we have some clarity on the domestic political front. That uncertainty has been removed. I think importantly, some of the other strengths we look at when it comes to Canada is, Canada was really entering this position entering this period of uncertainty in a relatively good position. Deficits, were around 1% of GDP, headed downwards. Debt was on a declining track as well, albeit still at a high level. We know that outlook is shifted now, part because the economic growth outlook has weakened, also because the fiscal direction of the federal government has shifted. So we're undoubtedly, we expect to see larger deficits and rising debt, but we're coming at it from a fairly good starting point, and hence we feel that there's still flexibility within that AAA rating for Canada to endure this, what is likely going to be a period of somewhat larger deficits and rising debt over the near term.
And one way, obviously, to know the fiscal situation of governments is through budgets. You already alluded to this. So federally, the Carney government plans to separate capital and operating spending budgets. So I'm curious to hear you on this. Does DBRS have a view on this approach, and will it influence at all how you look at Canada?
I guess the simple answer is I would say no. I don't think it changes how we look at Canada. I mean, it's not unlike what we see across many provinces where they'll present both an operating and a capital budget. At times, those can be separate documents, separate presentations. Other times, they're combined as one, one release, one fiscal update. But the notion remains the same. And I guess, so I think what it could mean for Canada's budget is we'll see a new presentation in terms of how the numbers are presented, but it doesn't change the accounting practice. When we look at the year-end results, the audited financial statements for governments, government has some discretion in how they present a budget and what that presentation looks like and how it's broken down. But there's really limited discretion in terms of the audited financial statements. They have to follow public sector accounting standards, and that will continue to be the case. So nothing really changes there. And I think further, what Prime Minister Carney has talked about is reining in the operating budget, so getting to a balanced position on an operating basis over the near to medium term, but perhaps continuing to run deficits for what is deemed to be and viewed as critical infrastructure spending. So I think that's the notion that they're trying to tackle and address with this upcoming change in presentation.
So you mentioned provinces and how they present the information. How do they compare to the federal credit rating? Are there provinces that should be paying increased attention to their spending, deficit, and debt?
I certainly. So I guess as a starting point, we don't have any provinces currently rated AAA. In the past, Alberta was there for a number of years, but due to volatile oil prices, rising deficits, and increased debt, we lowered that rating in Alberta a number of years ago, and so it's at a lower level. Our provincial ratings currently, the highest would be British Columbia right now at AA high, although we recently changed that to a negative trend, which is sending a signal to our readership that rating is at risk of moving lower, depending on how things, how the government performs from a financial and debt perspective. And at the other end of the scale, we have both Prince Edward Island and Newfoundland and Labrador are rated at A, both with stable trends. So, several notches below where we would have BC, but it's nonetheless still a strong credit rating. So in the latest rounds of spring budgets, we have certainly seen the forecasts point to much larger deficits across virtually all provinces and rising debt. So that is a concern. For likes of BC, we note it is putting downward pressure on the rating. For some others, it is perhaps taking away some upward momentum that may have existed previously. So we don't expect to see a whole wide swath of ratings downgrades in the current environment, but certainly we wouldn't anticipate any positive rating actions in the near term.
So if we think of the provincial level, we can also think of hospitals and post-secondary institutions that are kind of creatures of the province in a way. So I know that you rate some of these organizations. So what trends are you observing when it comes to hospitals and post-secondary institutions in Canada?
Yeah, I'll start with hospitals. I mean, certainly there's no shortage of pressures in the healthcare system, but from a credit risk perspective, we view public hospitals in Canada as being very closely linked to their provincial entity, so the provincial government and where they reside. And that's really because of the importance of healthcare for provinces. It's the number one spending item. It's the biggest area of pressure for most provinces. And it's one that continues to be addressed. It's not to say there aren't challenges and significant pressures there, but we expect the provinces to continue to meet the needs of their hospitals and keep them, from a credit perspective, very closely aligned with the credit risk of government. We do tend to see hospitals are required to produce balanced budget and basically operate on a near balanced position. And we do tend to see them provinces providing them with additional resources to meet their kind of inflationary and volume pressures. The demands are, I would say, insatiable, but when there are additional pressures building in the system, they do tend to get met. So from that standpoint, we rate all the public hospitals we cover right now in line with their respective provinces. So really on par. It's a little different when we get to universities. We view these, it's the higher education sector and universities specifically as being more arm's length from government, really having greater autonomy to manage their affairs. But there is still quite a bit of pressure on that sector because of the role that government plays, particularly in constraining revenues. So universities generate the bulk of their revenues from tuition, operating grants, as well as international tuition from international students. And we've seen pressure on all three fronts. So operating grants are largely flat or increasing only modestly, while tuition frameworks tend to be fairly restrained. Just look at Ontario, that's frozen tuition for a number of years. And more recently, we've had changes at the federal level to restrict the number of incoming international students. So that was kind of a release valve for institutions for historically, and an avenue in which they could grow revenues, bring in new students, and there were not restrictions on those tuition levels that they could charge. Now that that door has kind of been partly closed. So the flow of those students has slowed down. So universities are certainly under pressure, and we've taken some rating actions as a result. Most recently, we placed the ratings for Carleton University on a negative trend, and Huron University College, that's affiliated with Western University in London, we downgraded those ratings previously as well.
So we've talked about the provinces and the federal government. We'll get to municipalities, but before we do, I kind of want to step back a little bit and kind of look at the Canadian economy more generally. Are there any, so thinking more specifically like on the corporate industry side, are there any red flags or areas of concerns that you're seeing for some industries?
I mean, I think like everyone else, we're probably most focused on those that are, subject to tariffs or under the threat of potential tariffs from the U.S. administration. And I think, more broadly speaking, I think in terms of the broader economic outlook is, I mean, Canada's still a trade dependent nation, so what happens in terms of the outlook for the U.S. economy and U.S. growth, that has a big bearing on Canadian growth. And the other piece I would just add in terms of domestic policy would be the population growth. We've just gone through a period of very rapid population growth that has really kept the Canadian economy looking fairly resilient. We're now in a phase where government, for a host of reasons, is slowing down that population growth, and that's going to lead to slower domestic growth.
So let's stay on the topic of corporate Canada for a minute. Before the pandemic, one thing that a lot of us were paying close attention to was corporate debt, which was rising and a bit of a concern. Is this still a concern from your perspective? How is corporate debt kind of trending right now?
Yeah, I think it's still a concern for sure. For this, we speak to some of our peers across the organization. I don't think we're seeing a significant increase in delinquencies. So yes, the level of debt is high and has been increasing. More recently, we've seen some interest rate relief from the Bank of Canada, so rates have came down. So that is, providing firms with a little bit of flexibility to continue to meet their obligations. So I think where I probably have bigger concerns is still the level of household indebtedness in Canada is quite elevated. If we were to see a material shock to the labor market, so meaning significant job losses in major industries, I think that probably has a more significant impact on the broader economy. Canadian households have been able to carry high debt for a long period of time now, in part because the labor market has been quite healthy. We are seeing some softness in recent indicators. And, as we spoke about at the outset, fairly high level of uncertainty as how things are going to play out economically.
So I don't want to ask you for the secret ingredient in the DBRS sauce, but you mentioned household debt. Is this factored in at all in your methodology when you assess countries or governments or other entities?
Yeah, so we're certainly, when we're looking at government ratings, we're looking, across the economy. It's a potential risk factor. So, elevated debt in various parts of the economy, be it in the corporate sector, in the household sector, or at the government level itself, it does pose a risk to the financial system, broadly, and how a region or an economy can respond to potential shocks. So, these are things that we continue to watch. They tend to, move relatively slowly over time with, and can ebb and flow, but nevertheless, still risks that we are watching.
Interesting. So I want to talk about Indigenous entrepreneurship. I know you've done quite a bit of analysis on the participation of Indigenous peoples in the capital markets, which I think is really, really timely. So can you tell us more about this research and the role of government financing programs focused on reconciliation?
Yeah, that's a great question. Something we're certainly watching, and we're working closely with our peers on some of the infrastructure and project finance teams that are seeing increased interest from proponents of projects involving Indigenous participation. So in just in the capital markets alone, we've seen an increased amount of activity of financing related to Indigenous projects. One of the organizations that we provide credit ratings for is the First Nations Finance Authority. Now, they got their start back in the mid 2000s, and this is an Indigenous-led organization created through federal legislation that is meant to provide cost-effective financing to First Nations in Canada. So communities that otherwise, wouldn't be able to move forward on some of their own capital projects because traditional means of financing through the bank channel or private lenders were too expensive. So the FNFA, First Nations Finance Authority, has a pretty significant growing loan book. The loan book exceeds 3.4 billion now. And interestingly, they just recently launched a transaction, the first 30-year bond by an Indigenous-led organization, which speaks to the demand out there and the increased awareness of Indigenous-led projects. We've also seen support from various levels of government. Both Canada, we know, recently doubled the size of their loan guarantee program for Indigenous communities and projects from 5 billion to 10 billion. Similarly, Ontario just recently tripled theirs, rising up to 3 billion. And various other provinces have recently launched loan guarantee programs.
And I think it's a timely conversation as well because we're seeing amid the conversation around building big things in Canada and infrastructure and projects, we're seeing a lot of governments provincially and federally engage with First Nations to make sure that they are partners and, through different avenues such as shared ownership and stuff. So definitely something that I suspect DBRS will be paying close attention to in the future. So let's move on to municipalities. I know I went around the firm and asked a few of my municipal colleagues what would they like me to ask you. So the first question, perhaps the most obvious one, what is DBRS's view on the fiscal health of municipal governments in Canada?
I would say our view is that generally municipal governments are in pretty good financial health. That's not to say there aren't significant pressures, but we view them as being relatively disciplined. Municipalities in Canada are depending on the province, they're bound by and required to adhere to balanced budget legislation. So they generally can't run deficits of any significant magnitude over an extended period of time. Those need to be addressed and dealt with and brought back into balance fairly quickly. And there are provincial limits on debt for most municipalities in Canada. And we tend to see municipalities operating well below those provincial debt limits. So broadly speaking, that we consider the financial health of municipalities to be fairly sound. Of course, there are like other levels of government, there are significant pressures.
And we cannot talk about municipal finance without talking about development charges or DCs. So as you know, they're used to finance growth-related infrastructure, but obviously they increase costs when it comes to project. Some people have said that they hinder construction as well in the housing sector. So, obviously the alternative to DCs would be for municipalities to pay for the infrastructure over a period of time through taxes rates. So from your perspective and the perspective of credit rating agencies, does a different approach to infrastructure financing matter at all?
I guess I would say it depends. And I foresee like two scenarios here. I think if municipalities take the approach to pay for some of this growth-related infrastructure, funding it with debt up front, with the understanding that it's going to be continue to be serviced by development charges over a longer period of time, over the life of that infrastructure, but perhaps those development charges are at a much lower rate. I think we could look at that as being somewhat neutral. We look at it as being, kind of akin to an electric utility where there's a, rate setting mechanism that is there to help ensure that entity can continue to set rates to meet its obligations. So, but they're, with an understanding that that infrastructure is kind of a long life asset and can be paid for over the life of it. So that's one approach, and where I think we would look at that as more as being self-supported debt. The alternative is, if municipalities fund this infrastructure with debt, but expect to recoup the costs through the broader tax base over time, then we're going to include that in our just broader measure of municipal debt that needs to be serviced by the tax base. So that is potentially, would mean we would look at that as incremental debt and being credit negative.
So you mentioned municipal debt. It's not as common as in the US, but some Canadian cities do issue municipal bonds. So how do credit rating agencies and investors usually look at municipal bonds?
I think they're viewed as being relatively high quality. One, for the reason I mentioned earlier is, we view the financial health of the municipal sector in Canada as being fairly strong. And so that tends to equate to fairly strong credit ratings. And, I think there is strong demand because they're looking for an element of diversification. Those investors that are buying high quality government bonds, that tends to be Canada, Ontario, and Quebec bonds, those the largest government issuers in Canada. They're often looking for an element of diversification. So they want some other names in their portfolio just to achieve that diversification, and municipalities can add an element of diversification. So I think the demand is relatively high, and on top of that, for investors, I think they would typically be looking at it as earning a spread or a higher return on those investments, because municipal issuers don't tend to be the largest issuers or the most frequent. So investors typically demand a higher premium or a higher interest rate on those investments. And that, that in and of itself, feeds more demand for the product.
And I think we've covered a lot of ground in this interview, anything from federal, provincial, municipal, Indigenous entrepreneurship, and even the corporate side as well. So it's a good place. It's a good place to wrap up the conversation. Travis, thank you so much for coming on the show. There was a lot of interest for your insight internally, and I know our audience will be very curious to hear your views on credit rating. As I mentioned, I think it's very refreshing because, in the political sphere, deficit and debt is kind of looked at a certain way. And then I think you brought a very interesting perspective, the one of a credit rating agency as reputable as DBRS. So thank you so much for coming on the show, Travis.
Well, thank you for having me.
Thank you for listening to Intended Consequences. The views expressed during this podcast are not necessarily the views of StrategyCorp. All rights for this episode are reserved, and the guests on the Intended Consequences podcast might be current or past clients of StrategyCorp. To find out more about the work of the Institute and to subscribe to our newsletter, visit our website at strategycorp.com/institute and make sure to follow us on Twitter and LinkedIn. I'm Sebastian Lebrec, and I intend to talk to you again next episode.